Hi, I'm Ray from W Consulting, and I'm here to talk to you about the amendments that have been made to IAS 1 on presentation of financial statements, and specifically on how the amendments impact how we present items of other comprehensive income in our financial statements. The amendments were made in June of 2011, and the reasons behind the amendments are essentially twofold. It's part of the greater project that we've got on convergence with the US, where we're trying to create one globally acceptable financial reporting language. And secondly, we're hoping that will improve on the consistency and clarity on how we present items of other comprehensive income in our financial statements. Now, if you have a look at where we are at the moment, there's no distinction that is made at all between the various items that go into other comprehensive income, which basically, again, when you go back to the various users and the various preparers of financial statements, different people are interpreting other comprehensive income in different ways. There's a common misunderstanding between the various parties that items that go into other comprehensive income are essentially items that are unrealized, and items that go into profit and loss are the realized items, transactions that have been undertaken by an organization. This has never been the case in terms of what is sitting in the standard, and should never have been read in this particular manner. So essentially what has resulted out of all of this is that we have an inconsistent basis for determining how items should be presented in the financial statements and how other comprehensive income, the definition of other comprehensive income, should actually be applied in practice. Hence the IASB saw a need for this particular project. The main changes that have been made to the standard are that reporting entities are now required to group items that are presented in other comprehensive income on the basis of whether these items will be reclassified, essentially recycled to profit and loss from other comprehensive income at some point in the future when specified conditions are met. The amendments that have been made do not address which items are presented in other comprehensive income or which items need to be reclassified. Now, what is other comprehensive income? If we go back to IAS 1, IAS 1 tells us that it requires all income and expense items to be presented in the statement of comprehensive income. However, where there's a standard out there that requires a particular item that may have been deemed to be income or expense to be shown as part of other comprehensive income, then such items are shown as part of other comprehensive income. This is especially the case when it comes to translation of foreign subsidiaries, foreign currency translation adjustments on foreign subsidiaries, any actuarial gains or losses arising on defined benefit plans, the revaluations of any property, plant and equipment, and to a lesser extent where you've got intangible assets, revaluations don't happen that often, any changes in the fair value of financial instruments in a cash flow hedge, or any changes in the fair value of financial instruments where these items are carried as available for sale in terms of IAS 39. What the standard now does, it requires that items of other comprehensive income be grouped on the basis of whether these items might at some point be reclassified from other comprehensive income to profit and loss. So the intention behind the standard is to more clearly reflect the potential effect on profit or loss in the future periods of any of these items that may be sitting in other comprehensive income. The amendments that have been made to the standard are applicable for annual periods beginning on or after 1 July 2012. Earlier application is permitted, but where you do earlier adopt the standard, you're required to disclose the fact.